Well, thanks very much, everyone. What a startling and sterling panel that was. Fantastic to hear about the actions of the asset owners. My name is Richard Mattison. I'm the CEO of Trucost, which is now part of S&P Global. And this session that I'll be introducing and chairing is about innovation in investment products and practices, realizing green fintech, or perhaps sustainable finance fintech. So whilst the panelists are getting mic'd up, I thought I'd just give a few introductory comments. Climate change is often presented as the greatest risk to humans on this planet. And I think most scientists and perhaps even some economists would actually agree that this is factually correct and a necessary statement to make to galvanize significant action. In fact, Stern at the last COP said that he felt that his estimates of the potential impact on markets and economies made in 2005 and 2006 were probably now a significant underestimate. So we face significantly more risk than we did by his original estimates. And pollution, according to the UN Environment Programme, or UN Environment, is actually killing 3 times more people than wars or terrorism. So we face some serious ESG risks. There is another way to think about this, though. Climate change and sustainability could be the greatest opportunity to build a future that we want. So we are actually at an exciting time and place, and there are lots of different reasons why. There are several different drivers. We have huge political will emerging in various different regions across the world. So we're seeing a lot of action in China, a lot of action in Europe, lots of Northern European action. I've been part of the European Commission's high-level expert group on sustainable finance. I was a member of that group for the last year. It was a fascinating time, and the Commission will actually publish its action plan on Thursday. And it's really interesting to see exactly how quickly political will can change and galvanize and change the nature of how we think about this agenda. For example, we've already had a consultation on how to incorporate ESG as part of investor duties within Europe. We have had many other consultations on how we can incentivize corporate reporting, how we can develop taxonomies, how we can create a better flow of capital that is aligned with sustainable outcomes. And I'm sure you'll hear more about some of these things in later panels. We're also seeing huge investor appetite. Philippe mentioned lots of numbers in trillions, and we're seeing, really exponential rise in things like green bonds. So huge appetite. Bank of America and Merrill Lynch have said that ESG is the best signal we have found for future risk. It's quite a bold statement. And in fact, Stanford University and Yonsei University have back-tested some of our data over the last decade worth of data, and they found that an investment strategy of long carbon-efficient firms and short carbon-inefficient firms would yield abnormal returns of 3.5 to 5.4% a year. And carbon-efficient firms are those with higher firm value measured in Tobin's Q, higher net income relative to invested capital, lower ROA, higher cash flow, and higher coverage ratio, and these cannot be explained by traditional factors. So we're seeing an emergence of investment themes, we're seeing an emergence of signals, and we're seeing a huge increase in appetite amongst investors. But something underpins all of this and seems slightly lacking, as emphasized by the TCFD and more latterly the high-level expert group on sustainable finance. We need better information in markets in order to galvanize that capital flow, in order to align capital markets with sustainable outcomes. We heard AP2 say the one that has the best information wins. We heard Norges Bank say we need more pre-financial data. So you're hearing from asset owners at the top of the chain that we need more data, more information to inform capital allocations. Yet we exist in an era of big data. And there are lots of tools and machinery to harness the power of information flow. We also have huge amounts of remote sensing in the world. We cover the planet with satellite imagery and satellite intelligence, and surely there are ways of using that information. We are in the age of artificial intelligence. AI at the moment is advancing due to algorithmic changes and data proliferation and huge increases in computing power. Some even say, such as Professor Max Tegmark, who is the professor of the Future of Life Institute at MIT, that AI could present the only solution to sustainability for the future. So all of this really leads to financial technology, or fintech, and green or sustainable fintech. Can robo-advisors advise us all to invest in a more sustainable way? At S&P, we're very excited by all of this. We sit at the center of markets. We inform markets with essential intelligence, and we're very excited and investing quite heavily in all of this space. So I'm very excited to introduce the panel. If you'd like to come on stage. Great. So I think what we'll do is we'll each of the panelists will give you 7 to 10 minutes of an introduction on the theme of how technology is changing the investor landscape. And let's start with Amine from BNP Paribas. BNP Paribas has been working on the ESG agenda for some time and probably represents a really mainstream perspective on this panel. Amine.
Thank you very much. And would like to thank Ben as well for inviting us to this panel. Yeah, first of all, I'd like to just, maybe for those of you who are not so familiar with BNP Paribas, just state a few things about the commitment of the bank. BNP Paribas has actually taken very strong commitment in terms of sustainability, and probably the last step was illustrated by the creation of a new head of engagement, corporate engagement, reporting to the CEO late last year. And we have a number of streams and programs going at the moment on sustainability. Personally, last year I was invited by the Banking Environment Initiative to chair a task force led by CISL, Cambridge Institute for Sustainable Leadership, on fintech and sustainability. And I thought, that's absolutely very topical. I've been working at BNP Paribas for 30 years, and for pretty much of the last 10 years working on commodity derivatives, trading and sales. And this is actually quite touchy when you look at a number of sustainability topics such as coal or agricultural commodities. So I was quite intrigued on how digital, which is another big theme at the moment affecting financial institutions, regardless of the sustainability agenda, how those two macro trends will fit together. So the work with Cambridge was actually fascinating last year. It was a very good illustration of what a cluster can bring by having a collaboration across various financial institutions. Banks participated in this work, asset managers, fintechs, and the idea was to come up with some recommendations about how to encourage and how to favor innovation processes along fintechs and sustainability. And what we did, because the program was so vast, and how do you define sustainability? Of course, you have the SDGs, but you could spend years and years. So what we decided to do was to focus on a few use cases that could provide a concrete illustration, and then from then generalize to rules that could be applicable more widely. There is a memo on the Cambridge Institute for Sustainable Leadership website, so I encourage those of you who are curious. It's pretty long, so I cannot summarize it quickly. But I would just say that one of the use cases, which was the most advanced, still at the proof of concept stage, was presented in December at the One Planet Summit by Andrew Voisey from Cambridge in Paris. And it is about how you can use the technique of a supply chain to look at the sustainability of production of tea in Malawi. So it's pretty precise, but how you use the technology of blockchain to analyze this supply chain and once you have that and analyze the data properly, put some financial incentive that rewards the producers with less expensive capital costs. So I'll stop that. I'll stop there, sorry. That's just to give you a flavor of what that kind of work could be.
Great, thank you, Amine. And perhaps, Andreas from Arabesque, you might wish to talk about how machine learning can revolutionize investing.
Absolutely. Arabesque is basically an asset management firm that we launched out of Barclays. And at the beginning, we just went into the sustainable finance probably with not too much knowledge about that. So we thought we'd take 1 or 2 ESG data providers, and then this is basically really something that is enough in order to capture all the information that you need in order to include this into your investment process. We run public equity portfolios, global and different regional portfolios as well. But what we found is when we went really deep into the data that it's basically like a Swiss cheese. There's a lot of holes in there. The other problem is that it's basically only slow to change. It's only annual data. And there's so much happening. And sometimes if you look into a CSR report, which was published in 2017 in April, this is as of the date 31st of December 2016. So if you look into the CSR report or the data that you get from a traditional ESG data provider, this is basically then over a year old. But unfortunately, stuff happens much quicker. So what we found is that we needed to beef up our game. And we added a lot of news analysis, we added some social media platforms, we added some NGO analysis, which is coming in on a daily basis. So we look into over 100 million data points. And obviously, this is something that you cannot do with people anymore. So it's simply impossible to do that. So in order to kind of grasp all this information and to integrate this into our investment process to make it relevant for performance, and this is our utmost important thing for investors as well, because there's a lot of people that still are not really bought into the sustainability piece. I mean, here, this group, everybody loves it and breathes it and lives it, but outside, it's not everybody, and we had it at the earlier panel as well. So in order to get these people, you need to make it performance relevant. You also need to be in this position to actually show and demonstrate that this adds performance. So we use artificial intelligence and machine learning in order to find the best combination of information to combine long-term scores with a very short-term signal. We look into 3 lenses. The first of 2 are performance relevant. The third one is the classical SRI lens. So we look into the Global Compact, which brings together more than 50,000 different data sources in 15 languages and has an assessment on corporations on human rights and labor rights and anti-corruption, environmental protection. Our chairman, Georg Kell, has set up the Global Compact, and he obviously wanted to have this nexus between corporates and investors around the Global Compact principles. We look into ESG, which is more relevant for performance. We're data aggregator. We're bringing more than 10 different data providers from the traditional ESG world together. And then we supplement this with our short-term signals in order to make it more relevant for an investment process. And the third lens is basically the classical exclusions, if you like. We're value chain because what we believe is in order to really deliver the mission of Arabesque is to make this transparent, because to our mind, sustainability dies in darkness. So if you make it available to everyone on the website of Arabesque, with a slight delay, but still people start to really engage with it. We have a lot of journalists looking this up and looking into our data and ask us why we believe a company is good or bad. We provide it to corporates for a very low price point, and we provide it to investors for a very low price point. What we hope to achieve is with the transparency and with the relevance for investment performance is to create a positive feedback loop, whereby this gets relevant for investors and hence gets relevant for corporates as well. And we service both. We work with a number of large institutions together, such as Accenture and State Street and Bank of New York Mellon. All the big investment banks are basically looking into it or already have bought it. In the Nordics, it has really a good pickup. In the Nordics, we make it available to retail investors. So we're really trying to get this out to a lot of people and to widen the circle of people that might be interested in sustainability. I'll stop it here.
Great, fantastic. That's very interesting. I'm sure we'll have lots of questions around data and exactly how you gather that real-time data later. So to move to Cecilia from the Stockholm Green Digital Finance. Pushing the frontier in green digital finance, how do you do that?
through green fintech innovations. So Stockholm Green Digital Finance is a new center. We launched only in May last year. And we are a not-for-profit center tasked to accelerate green finance and green investment through fintech innovation. So that's all we do. And the reason is that, as Richard, you mentioned in the beginning of your presentation, that we have seen this amazing momentum in the finance sector, especially in the last couple of years, not just in the finance sector, but also in the policy sector, really trying to ramp up sustainable investment and sustainable finance to deliver on the 2030 agenda. But we also see that in spite of this amazing momentum, actual capital redeployment is still quite limited. So we realize we need new and creative solutions to address some specific persistent barriers in the system to help unleash the full potential of financial institutions to deliver value in the real economy. And that is the background to why we set up Stockholm Green Digital Finance. It was actually also in some initial conversations with the UNEP inquiry who said to us, we would like to establish a test bed in this field somewhere. And we said, Sweden, we should do it here. Sweden is a very good place to do this thing. We have a very high ambition and leadership in green finance, and we have a very high concentration of fintech innovators. We have a well-developed financial market, and still we're quite limited, so it serves well as a test bed. So that's what we're set up to do. We do this through 3 different legs. We do awareness raising, talk about and showcase different excellent initiatives in the world, spread the news about them. We also do lots of international exchange and collaboration. We have a very close collaboration with the Stockholm Fintech Hub, but also with other partners in other markets through the International Network of Sustainable Financial Centers, where we help tease out the fintech agenda to accelerate green finance and investment. We're also a proud collaborating partner to the newly established Stockholm Sustainable Finance Center, which we will hear about in a later session. But we also do our own innovation, where we see that there are specific barriers where fintech can help solve them. And this is the reason for our project, the Green Asset Wallet, which is a blockchain-based technology that aims to bring efficiency, transparency, and trust to the green debt market in support of scaling thereof. And it's financed by the German government through the Emerging Markets Dialogue on Finance. And what we do in this project is that we are putting together a team, a very unique consortium of bankers, asset owners, asset managers. We have the tech innovators with the caps and researchers, and we put them in one room for the co-creation of an entirely new technology where fintech and tech innovations can really serve the investment community in this space to help accelerate. So the reason why we engaged in the Green Assets Wallet Innovation Project was that we saw that when financial institutions are ready to invest sustainably, there is a lack of credible green investment opportunities to act upon. Basically, there is the green bond market, which is of course fantastic, but this has led to an excess demand for green bonds and a shortage of supply. So we asked ourselves, can we, with the help of technology, lower the transaction costs for issuers to help scale the supply of green bonds? And can we also, with this technology, help support the evolution of other green asset classes to evolve alongside green bonds? Because far from all companies are eligible to tap into the bond market. And perhaps most importantly, can we, with this technology, support new entrants in emerging markets and developing markets to successfully attract investments from Northern Europe? Because this is really where the great impact is to be had if you look at the SDGs and delivery on the 2030 agenda. So what can we do to develop trust to invest in these markets, and also to reduce the transaction costs for these new actors to tap in and successfully engage in the green debt markets? And in this consortium, we are working with the full supply chain of a green bond, because we start to look at green bonds initially. So we have Mistra in the role as an asset owner. We have Öhman in the role as an asset manager. We have SEB in the role as an underwriter. We have Vasakronan in the role as the first issuer of a corporate green bond. We're soon to announce a few emerging market banks to join this group as well. And then we have Cecilia, the Research Institute, and we have Cromway, a blockchain engineer, and a Geographic Information Bureau on board in this collaborative team. And together we are co-creating this new technology that is based around 3 elements. So one is the validation of delivery on green promises as put forward in a green bond framework. So how do we do that in the most efficient way as possibly, and bearing in mind that we really want to support the new entrants from emerging markets to tap into the green debt markets. So we do this by developing smart contracts, and once certain preconditions are being met, in this case, evidence points that verify delivery on the green promises as set out in the green bond framework, the smart contract is executed. So today we're building this system around the way this works as it is today with actors, but what's more, we really want to demonstrate the opportunities for automated third-party verification through this blockchain-based technology. So we're doing that by bringing in the technology for remote sensing and satellite imaging. We're working with a tool called the EU Mapper that works with satellite footage. And we're bringing in pilots, green projects in emerging and developing markets that might be very difficult to verify and understand. Has that actually green deliverable been delivered? And how can we actually support those actors to report back to the end investors in a cost-efficient manner? So the EU Mapper actually recognizes, for example, that there has been no deforestation occurring, the forest is still intact, it's eligible to participate in the red markets, etc., or the solar panels in questions have actually been built. And that feeds directly into the blockchain-based technology. So it's very interesting how these type of technologies can reduce the transaction costs and deliver information through this third party. And this EU map, it can both recognize that it is solar panels, 2, the GPS coordinates, and 3, the area. And we're combining this with software that records the kilowatt hours generated. We also have a system in this blockchain-based technology for impact reporting, for making this more efficient, and reporting back to the end investor in order to enable comparisons and aggregations, etc. And most of all, thirdly, it's the opportunity to develop trust for new entrants in the green debt markets, and how to do that through this blockchain-based technology by building up a track record and demonstrating credibility. And this is one piece of the puzzle. So I think that there are so many different things that can happen to help scale sustainable investment and sustainable finance. Technology is one of them. So this is what we bring to the table.
Fantastic. Thank you, Cecilia. So on to PensionBee. Romina, do you want to talk about what PensionBee does?
Sure. Hi, everyone. I'm Romy. I'm the CEO of PensionBee, and we're an online pension manager here in the UK. And what we do is we help people to find and combine their old pensions from previous periods of employment into one new online plan chosen by them. A little bit of background around our story. So my personal background is in really traditional corporate finance, and I did most of my time at Goldman Sachs and Morgan Stanley. And when I left Morgan Stanley, I had to take control of my own pension. And having been in finance, I thought this would be a really easy thing to do. But actually, the pensions industry makes it very difficult for individual consumers to actually engage with their money. And so I struggled to find someone who would even take my money to begin with, until finally I did find a provider, and they showed me this menu of around 2,000 different fund options and said, here you go, pick one. And so I did, and I picked one that I'd seen, before somewhere, maybe on a bus, and put my money in this fund. And of course, promptly around 6 months later, the paper pack arrived in the post to let me know that the fund had gone down. And of course, I had paid around 7% in fees in the meantime. So a pretty poor outcome. And around that time, I started speaking to other people that I knew, just personal friends, around their own pension situation. And what became really clear is that no one knew anything about it. Either they had a couple of old pensions that were just languishing behind with providers from previous jobs, and they'd never bothered to move that money with them, or they had moved the money, but they weren't quite sure what it was doing right now. And so there was a very clear opportunity in the UK to introduce a service that would help people to find and combine those old pensions into a new online plan where people could see the balance, they could top it up, they could use it to plan for the future and forecast outcomes, and most importantly, become more engaged with their personal savings. And when we started off offering our product, which was in 2016, we had 3 products on our platform managed by BlackRock and State Street, very traditional defined contribution pension funds. And we thought, okay, let's see how this goes. And very quickly, what became clear is that the number one request that we had from our customer base was to introduce a more responsible product. And we hadn't really thought that we would achieve this level of engagement, but it was clear that once we gave people access to information about their money, they started to link it to their broader objectives in terms of realizing who they are as a person. And so we thought, well, we're the type of company that listens to consumers, and therefore we need to find a way to solve this need for our customers to feel engaged with their money through a more responsible product. So we went out to the investment management community and we said, let us know what you have, because we'd really like to put some sort of product onto our platform that our users can engage with. And in October, we selected the Future World Plan, which is a fund created by Legal & General to aid in the transition to a greener economy. And there were 2 factors really driving our decision with this plan. The first one is that we really thought that there was potential for outperformance. Now, I think everyone in this room is very much aware of the economic imperatives around greener investing, but for most of the financial services world outside this room, when they hear ethical or responsible investing, they think of negative screening or maybe positive screening, and inevitably they associate it with a weaker track record of performance. And so this plan submitted to us was really the only one that made the point that it was possible to outperform the benchmark rather than to just meet the benchmark with a particular fund. And so for us, that became really important because anything that we wanted to put forward to our customers, we didn't want it to compromise their pension. We wanted it to improve and enhance their pension returns. So that was the first consideration. The second one was around engagement. And I think, most of us know that pensions is not the most exciting topic. And so anything that we can do to create a level of awareness and a level of involvement from individuals with their money is a very positive thing because it leads to better outcomes and better behaviors. And so what really kind of moved us towards this plan was the fact that Legal & General promised to engage with individual companies according to specific agenda points in order to aid that transition to a greener economy. And where the companies didn't engage, then they would be excluded from the index. And so, for us, that was kind of a key aspect of why we thought this plan would not only help people achieve, better economic performance in their pension, but also better engagement with their pension overall. And so since we introduced it in October, we've had a really good take-up. We have around 15 to 20% of our new flows going into this product and being selected by the end consumer. And so we're really amazed at that. A lot of people think of sustainable finance as kind of a small sort of niche area, but actually our data proves that there is widespread demand across all types of age ranges for a product like this if it can be positioned in the right way to the end customer.
Fantastic, thank you, Romy. That's really fascinating. And finally, to Antti, Would you like to talk about the role of hedge funds in green finance?
Sure, thank you. Let me start by a story to give a little bit of a context of this my starting point of view and why I think the hedge funds can provide a solution. When I was a young man, I wanted to be a chef, a cook. And my favorite celebrity chef was a guy called Anthony Bourdain. And he was once asked what makes a good frying pan? And he said that the good frying pan there's only one quality in a good frying pan, it's heavy. The quality of the frying pan is defined by its weight. The good frying pan is heavy. It's just a kind of a simple laws of physics and laws of nature. A good frying pan is heavy. Now, if you have a good, heavy frying pan, you can make it better by a number of different things. Sleek design, advanced materials. You can make a perception of a good, heavy frying pan better by introducing all kinds of marketing materials. And if it's your particular cup of tea, you can take your frying pan to your religious leader, ask for a blessing, and it's probably even better. Now, obviously, things happen in life. I didn't become a chef. I became a sustainable finance expert. But I took this law of a good frying pan to sustainable finance. Now, sustainable finance, the only thing sustainable finance is that the financial system is about allocating capital. And the sustainable finance means that you allocate capital from less sustainable uses of capital to more sustainable uses of capital. Now, when you're doing this process, you can make it better by more data, more initiatives, more commitments, more communication, and stuff like that. And it's going to make it more better and improve it. But effectively, if you're not allocating capital, from less sustainable to more sustainable, there is no amount of data, there is no amount of expertise, there's no amount of commitments that is going to make that particular investor or particular investment process sustainable. Now, there's one observation and then two innovations that I'll come eventually down to. One observation is that I think everybody in this room has followed the industry for quite a while, and you've witnessed this conceptual explosion of sustainable finance. Now, there's a number of different statistics that people like to throw around about what kind of it says that how much bigger and better and more important the sustainable finance has become. Richard went through a few on the introduction, but my favorite four are that you can talk about the number of PRI signatories from 0 to 2,000, an amazing amount of growth of organizations that have made a public commitment to integrate ESG into their investment decision making. 15 years ago, a success of a sustainable fund was measured in millions. 5 years ago, we started to about billions, and now we quite casually throw around trillions, in announced or self-labeled as ESG or SRI funds. That's a by any means massive amount. The ESG data market has grown from 0 to millions, tens of millions by any measure in a very short distance of time. And I'm willing to claim that there's more open positions for sustainable finance experts today than there were sustainable finance experts 10 years ago. Now, if you noticed, those four I chose very intentionally, because none of those four will allocate capital yet. Like signing into a PRI doesn't mean that you're allocating capital. Buying into data doesn't mean that you're allocating capital. Hiring sustainable finance experts in your organization doesn't mean that you're yet moving capital anywhere. And no matter how much you claim that your fund is sustainable, doesn't yet mean that you're allocating money sustainably from less sustainable to more sustainable. Now here comes the two innovations. So I work in a ESG-based hedge fund. It's a very quant systematic driven, and the ESG and the sustainable finance is really the kind of a core of our mission. That's the only thing that we do. We go through the world of looking for ESG signals, and we kind of allocate accordingly. We take short positions in the less sustainable kind of finance, less sustainable companies, and we use that to finance long positions in the more sustainable companies. And we realize the difference in between for two reasons. One, it's a very good business. It creates an absolute return. But secondly is that it facilitates this allocation of capital, because we want to see the capital get allocated from less sustainable to more sustainable. That's the only thing. Now, two innovations. One is that the obvious original first problem is that how do you measure this allocation effect? like if you're a long-only investor in listed equities, then you have thousands and thousands of different choices how you do. You can do it in-house, you can do it externally, you can use a consultant and so on. But effectively, your choice is that out of thousands of listed companies, a typical investment universe of thousands of listed companies, you're choosing one versus the other. And with that, you're allocating capital for someone and not for someone else. Now, how do you measure this, that how much gets allocated and how that allocation links to that sustainable development? Now, it turns out this is not particularly difficult. This is a kind of something that your quant managers and your risk managers have been doing for decades. Now, I'm going to give you one technical sentence. Please bear with me, but I'll explain myself later. Now, only thing you need to do, that you need to establish a linear factor model to measure cross-sectional variance of portfolio holdings with regards to sustainable development, and use this factor model to establish a minimum variance portfolio to measure how much active shares you are using in order to achieve this allocation. Now, most people, this doesn't mean anything. Like, I have to admit, it was maybe 5 years ago when I was a kind of a ESG analyst and not working in quant finance. It didn't mean anything. The only thing it says is that you can, without your risk manager, currently has tools and access to, when you have tools and the market information, you can take any portfolio of listed equities and you can measure the alignment of that portfolio to sustainable development compared to any benchmark. It can be compared to your peers, it can be compared to kind of a traditional investment benchmark, but you can measure this alignment. If you, for some reason, don't know how to do this, we have this tool publicly available. So if you're an asset owner and you want to know your equity allocation, come talk to me. If you're an academic and want to kind of use this framework and this kind of type of tool in your academic research, come to talk to me. This is something that we as a hedge fund are in the process of making publicly available for free, because we think that this is something that everybody should be able to do and understand. It is that important. But now what we've done is that we have measured the ESG-ness of quite a number of portfolios, and this is where my lawyer advised me that under no circumstances don't start to mention names. So I'm not going to mention names, but I'll give you my general observation of having running this tool for hundreds of different portfolios. In one particular case, we took 25 funds, ESG branded heavy sustainable funds that are sold in the UK. They all have an MSCI World as a benchmark. MSCI World just means that they invest potentially in about 2,000, a little bit less, largest companies globally. And we took the best in class and the ESG integration funds, which means that we took out the kind of a very simple exclusionary strategies. We took out thematic funds. We took out kind of we took out the index hacking funds and so on. So we took a sample of funds that are sold in UK, investing globally, and more or less do a kind of as aggressive ESG strategies that they are in the market. And within those 25 funds, my American colleague calls the results the good, the bad, and the ugly. Now, I'll start with the bad. The bad one is that the overwhelming majority of those funds that are branded ESG and supposed to be the flagships of this industry of ESG allocation have very, very little ESG in them. Very little. Maybe 5%, maybe 10% of the risk goes to an ESG allocation. Now 5%, 10%, it's bad because it's downright misleading. Like a typical retail investor, when they choose an ESG, when they choose any investment fund, they end up paying, throughout the lifetime, they pay fees that are worth maybe a refrigerator or a car. Now if you go and buy an energy efficient refrigerator and it's not energy efficient, you're going to court. Or you at least you're kind of complaining to someone, you're writing something to your Facebook page by bare minimum. But it turns out that when you're running an ESG fund, you can make these claims without any kind of worry that somebody would kind of be able to verify or even try to confirm this idea that how much ESG there in your fund is. The good news is that there is a few, out of the 25 funds, there is a fair few that does exactly what it says on the tin. There's a fantastic ESG funds on the market that they promise that they do a very, very aggressive ESG allocation, and that's precisely what they do. That's very, very good. Those are the ones that we need, and so it is possible, and those solutions exist. The ugly is that there's actually quite a few, well, not quite a few, more than one ESG funds in the market where the ESG-ness is actually worse than the market. It means that there's a good chance that if you're currently investing in an ESG fund in the UK, you're paying high active fees to get an active ESG exposure to more sustainable companies, and where in reality you would have been better off just investing in the market. That would have been more sustainable by this any kind of measures. Now again, if you, I'm not gonna name names, but if you're interested to kind of verify your own portfolio holdings, that whether you happen to be investing in the very, very good ones or the bad ones or the ugly ones, just come to talk to me, and we're making this available. Now, lastly, the innovation and where the hedge fund kind of comes in. The fundamental challenge within listed equity investment when you're making this allocation is that you're not, in a long-only space, you're limited in your impact. Because the kind of basically the most aggressive thing that you can do, let's say a typical well-diversified listed equity investor invests in 5,000 different companies, right? And the most active allocation decision that you can do is not to invest in something. Like, and we've seen this, we've seen the whole thing, like, if you're a large institutional investor, and I have a lot of sympathy, I've been working for quite a few of them, is that the kind of ramming through a decision of divesting from a coal mine or tobacco companies takes unbelievable amount of memos, meetings, committee approvals, and kind of all kinds of exercises to do nothing but choose not to invest maybe a handful of companies, less than 1% of your portfolio weight, certainly less than 1% of the names, and then have to do the whole thing. It takes a lot of intellectual effort and organizational capital to ram a decision like this through. And in the end, the only thing that you're doing is that out of the 5,000 companies that you're currently investing, you're not investing, let's say, 10 or 20. So there's three things in it. You're not changing the alignment of your portfolio too much. Two, that capital allocation decision doesn't mean much to a particular company. Like if you choose not to invest in a particular company, it doesn't move its cost of capital, it doesn't influence its behavior too much or anything like that. And maybe the most worrying thing, and it's been discussed in a previous panel as well, is that it doesn't have the signal value necessarily to the company management. Now, this is only anecdotal, but there was a kind of a few years back, there was one of the largest pension funds taking ESG very, very seriously in the world, had made the decision to divest their shares for sustainability reasons for one US company. And there was a news story, and this was all in a newspaper, where the journalist asked, went through the kind of the motivation of doing such a call and so on, and the journalist basically asked that what did the company think about this? And the investor said that we don't know. We wanted to have a meeting with them to explain ourselves why we are divesting, but they wouldn't take a meeting. Now, if it takes a huge amount of organizational capital and years of memos and meetings and committees to make a decision not to invest, and that decision is not so important to a company that they would warrant a meeting, we have a problem. That's definitely a problem within a sustainable finance. Now, hedge funds can provide a solution, which is shorting. Now, before you kind of start to kind of talk about how irresponsible or not sustainable shorting as a tool is, and I'll be the first one to say that the shorting is not, it's been misused in a way, but there's also a lot of misconceptions about what shorting as a tool means. Like, one big misconception that I've heard is that a lot of people think that the shorting a stock is short-termist in a way. That if you're shorting a stock, you're just kind of looking for a quick win, and that's not just simply technically, that's not true at all. Any investor can make the short position in a particular stock for years. So it's not, it's just simply, it doesn't equate. But what the shorting does is that it multiplies this allocation decision. Like, instead of just divesting on something, if you're shorting that particular stock, it does three things. One, it multiplies the effect that you have in your own portfolio in terms of sustainability. Two, it influences more heavily on the cost of capital on that particular company than just simply not divesting, which basically means that the next time the company is rolling over its debt, or the next time it goes to the secondary market to issue more shares, it's gonna cost more for them to do the unsustainable, and it's gonna cost less for them to do the less sustainable. So you're actually influencing that. And thirdly, and most importantly, and I'm not saying that you should, as an investor, even need to short a particular company, but the fact that you have that tool in your toolbox, maybe the American company CFO will take the meeting next time you think about the sustainability of that particular company. Now, just I'm long-winded here, but I'll just kind of conclude. Like, one, sustainable finance is about allocating capital. It's also about using your influence as an owner. I think they're complementary, but I think allocating capital sustainably is a very, very key part of this. Two, measuring how you're allocating your capital is surprisingly easy. Like it doesn't require anything more than a kind of a standard market tools and a kind of an adequate risk manager to run these tools. And third, in order for this kind of a financial system to be sustainable, we need this allocation to be much more decisive and aggressive. And I'm just kind of suggesting that we need it to be decisive in order for the sake of the planet, but even that kind of a decisiveness or that aggressiveness doesn't have to be as difficult as we have let ourselves it to be. Thank you.
Thanks, Antti. So aggressive ESG, we'll definitely touch on that topic later. I'd like to start off by asking about customers. Fintech has been described as offering the creative destruction of financial services, rearranging itself around the customer. So how can fintech or green fintech put power in the hands of the customer? And actually, an ancillary question, do the customers want that? Do beneficiaries actually want that? So maybe, Romy, you could answer that first.
Definitely. I mean, for us, we are an extremely customer-facing organization. So everything that we do is driven by the customer. I think the critical link that, perhaps we didn't have 10 years ago that we really do have today between customers and companies is social media. So, the vast majority of our customers actually come from social media, but also engage with us on social media. And I don't mean just tweeting, my password reset doesn't work, can you help me? We actually see real demand for things coming from Twitter, coming from Facebook, and so on. And I'll give you an example of when the customer's voice made a real difference to the policies of another company. So very recently, we had a pretty public spat with a company that was being very, very slow in terms of their pension transfers. And the customers, our mutual customers, took this to social media and started complaining about the poor treatment that they were getting and what they perceived to be negative customer outcomes. And so, we had tried ourselves behind closed doors, through emails, through meetings where the meetings weren't taken, to influence some sort of change. But it wasn't really until the customer made their voice heard that company decided to take some change. And so for us, that was a really powerful example of how you can use the voice of the customer and how you can give it real kind of volume, if you will. Through social media. And I think the way that customers used to engage before was to, maybe write you a letter, maybe send you a phone call, maybe, I don't know if there was some other way to kind of, get in touch with you. But these days, they will take it public. And so I think when you have an important cause that impacts the consumer, the question is, how do you help them to take it forward? And so giving people that platform over social media, I think is key. And what we found is that people really care about sustainability. And at the end of the day, all of the money that people in this room are managing is for people. and trying to find a way to let their voice come to the forefront of the debate, I think will have a real impact on the way that other companies are behaving.
So just a quick follow-up question on that. The millennial investor, what does a millennial investor actually want?
I don't know if I like the term millennial. I think that, you know, millennial is often used for a person who is very kind of digitally minded. They like to see things on their phone. They like transparency. They like to be in the know. But in our experience, that actually covers, you know, a lot of people after the age of 35, which is where the typical millennial definition cuts you off. So for me, you know, it's not so much about millennials. It's about, you know, there is this class of people who wants openness and who wants transparency and who wants their voice to be heard and for them to understand finance. And that's really the concept of the millennial investor rather than a particular age. And I think they want involvement and they want engagement. They want to feel like they are close to their money and they understand what their money is doing. And if you can harness that and find, you know, outlets for these people to make their voices heard, then I think that you can drive change, you know, much more quickly than going through, you know, a 10-month process of getting position papers and policy papers approved and signed off, and then in the end, you know, the company doesn't care. Whereas if you make things very public, I think that, you know, they stand up and listen.
So a question for the three asset managers on the stage. Should every fund in Europe, in the world, have some kind of sustainability metrics associated with it? This is something we debated as part of the high-level expert group. I won't give you the answer, but what do you think? Andreas?
So probably I start. So to my mind, this will happen anyways. So if the notion is right that sustainability information around ESG or Global Compact or SDGs or gender or other topics in the broader sustainability world actually helps you to create a better performance, then there will be some pressure for people just to implement that. So it's kind of a self-fulfilling prophecy that we hope to also support with this data product that we are bringing out and making available to others, but also about kind of going out and speaking about it and making it public that sustainability can actually help you to improve performance. And then over time, it will just happen by itself. And I believe my job will not have any ESG acronym in my business card in the next 5 years anymore. I think everybody will have to do it. And it's driven by different dimensions. I mean, regulation is a big part. I mean, you've been part of the high-level expert group, but just IRP too. Like every corporate pension fund in Europe needs to integrate ESG now going forward. And I don't think that this is a kind of, you need to have a glass ball in order to see that Europe will make this mandatory for everyone in the future. So it's A, something that is driven by performance, and B, it's driven by regulation as well.
And I mean, does transparency change the behavior of the mass of institutional investors? Are you starting to see that?
I think it's too early to say that we see this, but I totally concur with what has been said before. I think it's not only climate change, but it's a perfect storm of all those trends coming together with better transparency, immediacy of information, and more direct access by the individual investor. So I think it's really too early to say, because it has accelerated massively in the last couple of years, but we're just starting to see the beginning of applications. But I'm absolutely convinced it's irreversible. There will be solutions. There is a ton of innovation that is going to happen. And this transparency and immediacy of information will reach the final investor. This final investor will have a say and will influence, and it will actually transform the industry, because today there are various layers or screens that are there because of the way it's put together. But technology and this access to information, I think, will revolutionize how it's used and how final investors are making their decisions of investment.
And Antti, are you seeing, of those funds that you measured, those UK funds that purport in some cases to be ESG driven, have you had any engagement back from those funds, and have they changed the way in which they're allocating their capital?
Yeah, it's a good question. So we don't kind of directly engage with the other fund managers and obviously we are spinning off the measurement business to be different simply because the asset manager is not credible and there's a conflict of interest of measuring other people's ESG-ness and so on. But we have had this, through this program, we've had kind of dozens of institutional investors who have seen the ESG profiles of the funds that they invest in. And I know that this kind of a dialogue takes place. It doesn't necessarily, by the way, mean that you would need to be kind of very confrontational about that. You're not delivering the goods that I'm paying for, but it's more kind of getting into the detail of what's the impact of this fund that you do. Because so far the relationship between the asset owner or anybody who invests in the fund, the fund manager, is a very, very asymmetric relationship. Like as a buyer of the fund, you can do that. You can ask that, well, is this fund really sustainable? And the asset manager says, yes, and that's it. Like there's no way to verify this claim, and there's no way to kind of to have a kind of a constructive dialogue if you don't go through the details. And to me, the kind of whether every fund should have a sustainability criteria or not criteria, but some kind of a sustainability measurement in this, it's absolute no-brainer for one reason only. Similar to investment risk, like whenever you make an investment decision, there's a risk involved, regardless of whether you're cognizant of it, whether you manage it, or whether you understand it. Very, very similarly, every investment decision has an impact. If you don't pay attention, if you don't measure it, if you don't manage it, it still exists. And I don't see any reason why this shouldn't be, as publicly available as an investment risk of any investment is.
So let me move on to some of the challenges here. So let's say that we have a completely transparent market. It's an efficient market with respect to sustainability. So you can get information on every single fund. If you're an asset owner, you have ultimate transparency, whether you manage your own funds or you outsource that management on exactly how sustainable those funds are. However, what are the dangers of this? Well, one of the dangers actually is, what if we are getting that wrong? What if we're not measuring sustainability correctly? So how can technology help us develop more sophisticated approaches to measuring sustainability? Cecilia, I'd be interested in your views.
Thanks. Well, first, actually, I want to take the opportunity to add to what Romina just talked about, the consumer angle of things, because I think this is really interesting. And what you see with PensionB, and I see that there are so many other opportunities there as well, where technology can help mobilize consumer action. One fascinating example is Ant Financial, which is the largest fintech company in China or in the world. And at last year's 2017 World Economic Forum, they launched a new platform for all of their clients. So the clients would have their savings account and their credit account, and alongside that, their carbon account. So they would record all transactions and be able to record and monitor the carbon account of all their clients. And this had an amazing response from all of their clients. They had, in less than 6 months, they had 12,000 million users to this new platform, which represents 3% of the world population. It's just amazing. That started to not only monitor the carbon footprint, but also making changes in the daily life. So what Ant Financial did, this financial service company, was to gamify the reduction of your carbon footprint. And it had this amazing success. So people started making different choices in their daily lives and also offsetting their carbon footprint through the planting of trees. And also in those 6 months, 1 million trees have been planted. So I think that's another very excellent example of how fintech can help mobilize consumer action. And another excellent example that I wanted to add to this is a company in Lithuania that works in Europe, in Northern Europe, on the decentralization and expansion of renewable energy. And they do this through a bottom-up approach by linking the producers of renewable energy with the consumers of renewable energy. So they are bypassing the way the market is structured today and whether those companies are struggling with accessing capital. And the way it's being done is through a blockchain-based platform whereby consumers purchase tokens that represent units of electricity that will be generated once these companies can expand their production. And either they can sell this unit or they can consume it, and they get to purchase it for a very good price. And that's another example of how you can mobilize consumer action to really scale and speed up the transition to sustainable societies. And I think this is really exciting. So this is one example of how technology can help serve this space, but of course there are many other examples as well of big data and AI and the technology we're working on right now is a blockchain-based technology. But I think that there are a lot of different opportunities that we may not really consider yet. Another excellent example, I think, that is a way to pick up on the natural assets part of sustainable development. We had some comments about that earlier from Conservation International, etc. One of the problems with natural capital and ecosystem services is that they are invisible in traditional markets. They don't have a market value, so they're hidden and they don't get considered in different types of decision-making processes. So if you have an area and you need to decide whether to replant mangroves or put a shrimp farm, depending on how you calculate the value of the land and the services provided by a mangrove forest, for example, it really influences your decision making. So there's a company now that is testing tree coins. So they are tokenizing mangroves, and an individual tree or mangrove represents a tree coin. And investors can invest in this currency and buy tree coins. And the more tree coins you buy, the more mangroves needs to be planted, because of course the currency needs to be represented by some real asset. And you can also trade this tree coin on an exchange called Vykke and get a fiat currency if you want. That's also sort of a new way by which technology can help serve this space and to transition to sustainable societies. So it doesn't only have to be how we can help serve the traditional established players. It can also be new inventions that simply help serve this transition to sustainable societies through new inventive ways.
Yeah, that's fascinating. So if I just sort of probe a little more on that, the Ant Financial example is amazing. 3% of the population of the planet suddenly grasping that they can have a carbon account. That's an incredible and pretty much overnight innovation enabled by technology that will create a big difference. Or will it? So those million trees as a carbon sink, what effect, is that the correct carbon sink? And in all of this, in the last couple of decades I've been working on this agenda, you always get questions about measurement and definitions and real economy changes. So maybe a question for Andreas. When you're thinking about your tool, how does your tool take into account real economy changes? How do you actually define sustainability?
It's not measuring the real change in the economy, because what we are trying to achieve is to grasp as much information about the actions of a company. So it's very difficult for me then to kind of bring this impact measurement, and that is one of the big things that's at the moment in discussion. And there's kind of the SDGs obviously as the framework around the impact measurement. We're starting to do this, and our first SDG lens will come out in the second quarter. We'll start out to kind of bring those 17 into 2, people and planet. And we're trying to measure as good as is possible with the technology and the information that is available to actually measure what kind of an impact the company has. So there's certain discussions around that, whether kind of a company that only can kind of, if you want to only measure the incremental new impact that a company is having, or whether you would like to measure whatever impact the company is having. To my mind, if you can have a positive outcome out of a company's actions, then this is something you should measure and then also get into your portfolio. So this will be the approach that we are going to take. So the impact measurement is something that many people have started to work on. I think blockchain will be a big tool going forward in order to do that. With blockchain, you take out a lot of the middlemen, and you can measure stuff more directly, and it's kind of like a shared ledger where you can store information on, you can put it out there. I mean, for example, a very good idea around how you can use blockchain is in the supply chain and get the carbon footprint of a product really measured in a good way. So to my mind, the greenhouse gas protocol is probably not the best thing in order to measure this for investors, because there's a lot of double counting and you're a black belt in carbon yourself. But if you can basically have a product that has from the start of the production until kind of the consumption, a carbon account that's kind of building up similar to what's happening in China, then kind of the end consumer can then start to pay for that carbon. So that goes then into the polluter pays principle. So there's a lot of stuff that's happening, and we're just in its infancy. But to my mind, this is really important that technology will be leveraged into finance in order to also measure the impact.
To add to that, that's something also we're looking into with the Green Assets Wallet, whether we can put reporting on a blockchain to avoid double spending and to really help both issuers and investors understand what belongs where.
So it sounds like we have data, it sounds like we have technology, it sounds like we have appetite and demand for this information. A question for you, Amine. Do we need regulation? Do we need the financial regulators in this room to regulate to enable that to work?
Absolutely. Yes. No, and just to elaborate a bit on the previous question, I think technology and data, it's not magic. I don't think we will have necessarily all the answers through this in terms of measurement. I think there is science as well, and we don't have. I don't think we have all the answers through science yet, but technology in a way can be used by science. For instance, artificial intelligence and big data is a tool that can help science, but I don't think it's 100% clear that we can still measure all the impacts of related to the SDGs and have a proper definition. So I think it's a long-term journey, and in the meantime, it's like a little bit back to the green and brown thing. While we don't have the final answers from science in every single case, it's still good to do the best rather than the lowest in the meantime. Back to regulation, I think regulation is one of the big helpers in implementing this change right now. So for me, there is a regulation, there is the digital, and there is this strong millennials and awareness. But regulation is absolutely key. I think we have to be careful how regulation is implemented. There are big debates around, the best is the enemy of the good sometimes. If we try to be too finely tuned into the maximum detail, there is a debate out there. I'm not yet, my mind is not made up on that. For instance, on green bonds, do you want to have something which is extremely prescriptive at the risk of maybe making that market not grow? Or do you want to leave it a little bit more wide open so that you still give it more space? But I think regulation is very important because it will also force actors to change and to report.
Yeah, I mean, I also am of two minds about whether regulation can solve all of our problems. On the one hand, it sometimes feels like when the regulator gets involved, you're sort of saying, okay, the regulator's going to sort it out, no need for me to do anything. And I think that kind of attitude is not, very helpful where you need mass movement. On the other hand, there's a real information asymmetry when it comes to, ESG-related data. I think the fact that you were able to find, the good, the bad, and the ugly, and the fact that the ugly even exists, indicates to me that there is some kind of, reporting, asymmetry that needs to be addressed. A clear example is, new regulations that are coming into force in the UK that require companies to report on the pay gap between men and women. And that is, a fairly basic piece of data that's going to have a huge impact on behavior in the boardroom and hopefully throughout many levels of a company. So I don't feel that regulation, needs to be, entirely prescriptive in order to address a problem. I think if we can start at the basic levels of ironing out some of the information asymmetry that exists, then we will already have a really high impact and a basis to let other people come and engage, for example, the consumer or the press.
Mm-hmm. And then one final question for me, and then I'll open it up to the audience. You know, if we're thinking about real economy changes, we discuss consumer behavior and financial examples like that, changing the behavior of consumers. How can green fintech encourage a change in behavior and the strategy of companies? So, you know, Antti, your answer might be shorting. You can comment on that. But, you know, is there another mechanism here to you know, if that company that was divested knew in advance of divestment, or, you know, are there mechanisms here that technology can enable that information flow from a company's board to the investor and back again? Cecilia.
Well, one thing that we're considering as an expansion of the Green Asset Wallet is, of course, what we can do not only in Green Debt, but also when it comes to equity and incident reporting. In a previous life, I used to work in an analysis house that monitored large universes of portfolios. And the problem was that where incidents occurred and they couldn't be verified were the most challenging markets where there was no civil society available present, so that we could have all of those different, you know, 3 different points of verifying the same incident. So how could technology help serve that space? Through crowdsourced information, for example, whereby you would have a lot of different people, individuals reporting on the same thing on the blockchain and confirming each other's that this has actually occurred. And that would make it so much easier for investors to use their influence to push those companies. And also, when it comes to the follow-up work, has this company, for example, cleaned up this river or not? And you could just, through a simple app, have thousands of people in the community say, yes, my drinking water is now clean. Yes. It would make things so much more efficient for the reporting back between what's happening on the ground and how owners can influence their companies.
So you're saying essentially that technology, if I paraphrase, could disintermediate corporate communication and investor relations?
No, it could bring the information to the investor to make informed engagement processes more efficient.
Yep.
Basically put the companies under pressure to then really change.
Yeah.
So technology and the gamification of information can really be something that can be fed back to a company. So whenever we talk to a company, sometimes just happens that they hear it from the outset that something went wrong. So one example is, like a mining company we talk to quite a lot, is they just found out that there was again a fatality in one of their mines, and one of their people just chose to not report it up. So kind of it went through outside channels to them. So if you really can create a lifestyle feeling of finance where people use technology in order to feed back whatever they find and see. Also with PensionBee and what they're doing, kind of this interaction that's really, really valuable and helpful in order to put pressure on companies to change.
Great. So any questions from the audience? We have 2 at the back. We'll start with that.
Hi, thanks. Tom Harrison, the Sainsbury Family Charitable Trusts. So just a quick comment, Antti. You said that divestment's hard, and you said that companies don't care. For asset owners like us, it's pretty straightforward, right? We just change the investment mandate, don't invest in oil and gas sector, and we're done, right? So it's not hard necessarily, just that point. In terms of companies don't care, Shell rang us up and said, can we have a meeting after we'd divested? Another example, a university had a vote to decide whether they wanted to divest. The day before, oil company flew out to them across the Atlantic to have a conversation to try and dissuade them. So I think that to some extent they do care, and we should pay attention to that. Romina, to the PensionBee, I'm almost signing up. I'm persuaded, right? It's great. But the Future World Fund is a good fund. And the key thing is what progress it makes on the climate pledge. So it's been over a year since they committed to that, right? So they haven't actually reported yet. So how do you engage with Legal in General, and what will you do if they don't meet the climate pledge commitments?
So we are expecting the first year of performance data to be released shortly. According to FCA guidelines, Legal in General and us, we're not allowed to report what has happened where the time period is shorter than a year. And so it's not for a lack of wanting to say what the performance has been, we're just not allowed to at the moment. You know, the examples that, you know, we have seen in terms of corporate engagement, there is sort of a, you know, a periodic communication that comes out from Legal & General that describes the individual engagements that they've had with different companies. The fund has been in existence for a year, so what we can see is, you know, the internal performance that we have, which I won't comment on, but also that the engagement is taking place. Now, you can make your own decision as to whether a year is too short or too long for an engagement to occur, but ultimately the fact that there is reporting on the engagements occurring and whether change is occurring means that there can be feedback from our customer base back to Legal & General in terms of what it is that they would expect to see. And so we very much intend on making that feedback loop you know, known, because that's one of the reasons we got this fund. We want people to engage and to make their voice heard.
Antti, do you want to respond to divestment?
Yeah, sure. Yes, I was being intentionally provocative, but I stand on my ground. I do know that the companies do care and they do take meetings and so on. I'm not. My point is that and I don't think nobody in this room disagrees about the direction of travel. It's the speed that worries. Like, I think companies do care, and this is, by the way, not my line. I think the person who said it last night is somewhere in the audience. Yes, I can see him. So it's about the speed, and I'm absolutely positive there's a all company executives will take meetings, call companies will take meetings, they will hear your concerns, they will listen, they will understand. But if the capital allocation of you as an investor doesn't reflect, the company behavior doesn't change, I would be willing to go as far as saying that the only reason why we still will have a carbon-heavy energy sources in 2025, 2030 is because we as an equity investors are comfortable on holding the stock of those companies today. So it's not about the direction of travel, it's the speed that worries me.
Okay, there was one further question at the back, I think.
Thank you. Jacob Tomei, 2 Degrees Investing Initiative. I have a question for Andreas. So we're building a product in Germany that allows retail investors to create a client profile on climate. You'll know in the German market, climate and nuclear is obviously a controversial issue. So we're seeing a huge variety of how retail investors think about what sustainability means to them, which suggests the need for more differentiated products as opposed to a general ESG product, a climate-free ex-nuclear, climate ex-fossil fuels, etc. So that's on the one hand, this client profile piece, and the other piece is then, of course, the opportunities with new technology. Remote sensing was mentioned to have a much more granular view of what's actually happening in your portfolio. I'd like to ask you how you see these two technology trends coming together. So on the one hand, projects like the ones we're conducting on creating client profiles, but then also creating more granular retail product profiles and perhaps a broader suite of retail products that are really unique to each individual investor in the market that interfaces with you.
I think that's the future. So I think technology will be an agent of change in the way that you do not have like one fund for 1 million people, but you have 1 million products for 1 million people. So we believe in, like our chairman calls this Generation S, and we believe that through systematic and quantitative investment processes, you can actually ask the people, and this is something that we're working together with a couple of big wirehouses as well, is you can actually ask the people on how they stand in terms of the SDG. So how important is life below water for you? How important is the gender diversity issue? And then they can basically pick and choose, and you can build a profile for them. And based on that profile, you can basically build a list of exclusions and a list of positive tilts in the portfolio, and then you can give over an investment universe, which is something that is suitable for that particular client, and then you can manage that based on this. So to the first part of your question, I think this is absolutely the future. I think the days are gone of big funds where basically you push people into this and then they don't understand what is in there. The second thing is then also to make data available to them and more visible to them. And this goes into this creating a lifestyle feeling that I just mentioned earlier. I think it's pretty important for the people that at some point in time they will have a connection because they would want to know, okay, well, not only that they make good money, but also that this good money is made not at the expense of other people. And so I think you're absolutely spot on. Both things will happen, and probably sooner rather than later. These things always change, like it's a non-linear change. At some point in time, we'll just see it happening.
Okay, question at the front right here.
Thank you. Anthony Hobley, CEO of the Carbon Tracker Initiative. So my question, in a sense, is how can we link the topic in the previous panel, so the TCFD, age-leg recommendations, forward-looking disclosure, with fintech, blockchain, etc. I mean, we're in a transition. The problem is, a lot of the way we think about this, we model, is backward-looking, and a lot of disclosure today is backward-looking. Doesn't help you when you're in a transition. And it's probably why, we've been in transitions before. Every technological transition, it's effectively, the given is 9 out of 10 incumbents fail to survive because they don't know how to assess what's going on. So how do we take the recommendations around forward-looking disclosure, stress testing business models against how the world might be, we're not going to predict it exactly, and use fintech to help us? Now, we also know that the companies are not the greatest at disclosing. So there's legal action going on in the US by the attorney generals around the allegation that the companies haven't entirely been forthcoming to their investors about the risks. Now, one of the most downloaded app in the world is the Beijing pollution app. So we've got similar things happening everywhere. So you've got millions upon millions of these phones that can collect data and feed them back. We've also got satellites. Can we effectively use fintech to bypass the companies and go and get the disclosure directly, and effectively use AI and so on to model the impacts, so that investors and effectively consumers have that information at their fingertips? Is that a solution? Can we marry the two?
Who would like to take that?
I can take that, because we've been discussing, in the course of our exploration of all the fintechs and what they do, we came across some fintechs that are specializing in analysis of information on the web. So it's a sort of big data approach where you go and you scan the web and or other sources. Some are more sophisticated, and they will choose some sources to take information which is not company delivered, but which is coming from other sources. So not only it's real time, it can be targeted, and it can provide additional information. But I think it's only a partial answer to the problem that you're saying, because you still need to know what are you measuring against. If you want to be forward-looking, you need to define what would be a path, a scenario, and is the company progressing along that. So I think there are bits of answers, but not everything, as I'm saying.
I mean, one of the challenges is, you have forward-looking information. Let's assume you can get hold of that information. You create models. No models are perfect, but you create models. Quite often, what investors need is back tests. So you have forward-looking information that is unback-testable. So that's a conundrum. I'll leave that for maybe another panel. But anyone else want to add any comments to that particular point?
Maybe. Yes, I would absolutely. I would agree. There are two things there. One is that the companies are usually better positioned to establish their own risks in a way. That the relationship between the company and the investor is always asymmetric in a way that the companies are better positioned to kind of provide a kind of a minute detail about their carbon emissions, for example, or their water use and stuff like that. So that's for sure. But at the same time, I very much agree that the kind of all kind of transition risks, related risks, for example, you don't need necessarily the company to provide that. In fact, when horses turned into cars, I don't think it was the horse owner who was the one who would kind of be signaling that, I think my business model is dead. Like, let's look somewhere else. I think it's very, very similar. You can look it outside. In fact, I think company's sustainability profile and how sustainable a particular company is ultimately is not the company themselves to decide. They can influence. It's a bit like a brand. Like company can influence that how their brand looks like and so on, but ultimately they can't dictate how valuable their brand is. It's the stakeholders around that particular company And in a brand case, they're the consumers and the buyers and the clients who decide that how valuable that is. It's a very, very same thing for investors in sustainability in a way that it's not really up to companies to decide that how sustainable they are. They can influence that and they can change behavior and they can do things and they can communicate and they can do a lot of different things. But ultimately, I think in order for any sustainable or responsible investor to decide that how sustainable a particular investment is, it's up to that investor, not the company, to
Sorry, one quick point. It's not just about sustainability, it's about financials. So
yes,
you
yes.
put your money into US listed coal stocks 5 years ago, you lost about 100% of it.
Yes.
You put your money into EU energy utilities 10 years ago, you're now down 60 to 80% because they made the wrong strategic decisions, and actually they're the wrong sustainable decisions as well.
I very much agree. I very much agree. And there's no difference between the finance and the sustainability. You know, it's very much married, all interlinked, different sides of the same coin. I agree.
Great question. Just to answer in terms of the green assets, what we are thinking about if we could, in the impact reporting element, consider this somehow. And I don't know if we have the solution. We will have to see. But we are thinking about the fact that a green bond is an instrument for the investor to sort of help transform companies towards more sustainable activities and making that transition. And if you see that the green bond portfolio is growing, but the brown portfolio is growing equally of that company, doesn't make sense. So can we do that? Can we link the impact reporting and put this on a blockchain so that you have this track record that will always be there? You can't corrupt it, and to support investors to monitor and follow whether companies are making the journey seriously towards the right transition. But it's a good question.
One final question, and then we have to go to lunch. I don't want to hold you back from food.
Thank you. Bob, you were Imperial College. I wanted to pursue very briefly the question of regulations versus standards. And you mentioned the green bond market. I'm a firm believer in the fact that it doesn't need regulation, that the market is working perfectly well with a set of standards that are kind of loose, but everyone kind of gets them. And the one case where someone tried to, move outside of that was Repsol, and the market said, no, that's not going to work. So there is a case to be made for self-imposed standards versus regulating something. I think regulations for green finance are probably a good idea, but not necessarily for green bonds, because it's already out there. And I just wanted to sort out in my own mind, whether or not what we're really looking for is a set of standards that everyone kind of consensually agrees to without the need for bringing in regulators. I mean, regulators are really a last resort when you think about it. And it may very well be that it's, this kind of grouping is the kind of thing that will lead to a set of standards on these issues that, particularly in terms of disclosure, that will sort of eliminate the need for that. Just throwing that out.
Standards eliminating the need for regulation. Any comments on that?
I mean, I think in 2008 we had a lot of self-regulation going on in the banking sector, and it just didn't work for that particular time. I think when you're very early on in a particular industry, self-standards can be a lot more efficient, but also the motivations of the players going into that sector, I think are more genuine and therefore more conducive to self-regulation. I think that once an industry matures, you attract all types of players, and it's really hard to kind of do away with regulation, because what you risk then is that things turn really sour and you get over-regulation, which ends up killing an entire industry. So I think I would prefer to kind of err on the side of having a little bit of regulation, just to control for certain, really bad things.
I agree with Romina. I think that there's really a balance act here. We don't want to kill the market, especially for green bonds. We don't want to kill it. It's already a high transaction cost to enter this market. And that's also something that we consider with this technology that we're producing. How can we sort of inject full transparency into this market and depend upon a natural selection of investors choosing those green debt investments that make the best sense for them. And we think that if you are, for example, a credible actor, you might perhaps be more flexible in terms of the evidence points that you pick to verify your green claims. If you're a new entrant, maybe you would be forced to pick some more very specific KPIs to actually demonstrate that you have delivered on specific promises. And we do think that there will be a natural selection if we can just bring full transparency and immutable verification of delivery on your green claims. That can help serve this market.
Great. So I'm just conscious that we have to go to lunch. Remains for me to thank the leaders in the intersection between finance, technology, and sustainability. Please use the app to vote for every single one of them, which you may not find. And please enjoy lunch. Thank you.